Hey traders, welcome back to the channel. Today we're diving into one of the most powerful scalping strategies top traders use to stay ahead of the game. Whether you're a seasoned pro or just starting out, this strategy will transform the way you trade. In this video, you're going to learn exactly how to decode how trading machines and algorithms move the market, the hidden patterns that big institutions leave behind. Once you know how to recognize these patterns, you'll be able to spot institutional trades as they happen and take advantage of the same opportunities. But here's where it gets even better. I'll be sharing 4 costly mistakes I made when I was starting out. These mistakes set me back over $13,500, and I'm giving you the blueprint to avoid them, so you can fast-track your own success without paying the same price. And the beauty of this strategy? It's designed for the 5-minute time frame, so it's fast, effective, and doesn't require top-down analysis. And it works across all markets. If you commit to mastering this strategy and learning from my experience, you can transform your trading approach and see real results. Stick with me, because what you're about to learn could be a game changer. Alright, let's dive into the foundation of this strategy, supply and demand zones. A supply zone is a price area where selling pressure is strong enough to stop the price from going higher. This zone often appears after a rally or uptrend when big players like institutions or banks start selling to take profits. As a result, the market reacts by dropping from this level. A demand zone is a price area where buying pressure is strong enough to stop the price from going lower. This zone often forms after a decline, where big players step in to buy, pushing the price back up. To spot where the market is likely to move, you need to recognize that supply and demand zones show up in 4 distinct patterns. Mastering these patterns will help you identify when and where the market is most likely to reverse or continue its trend. Let me introduce you to the drop-based rally, a powerful bullish reversal pattern. This isn't just any price action, it's the footprint of smart money at work. Here's how it goes. The price drops. This is the market pulling back, often shaking out weak hands. Then comes the base, a consolidation phase where buyers start quietly accumulating. But here's where the magic happens. This isn't just consolidation, it's manipulation. The smart money is gathering strength. Finally, we see the explosive rally. Buyers take control, driving the market upward. What's happening here is more than just a price move, it's a strategic play by institutions. They push the market down, accumulate positions at the base, manipulate the market to get the best price, and then let the rally fly. Now, let's look at a real chart example of this drop-based rally pattern. As you can see, the drop isn't just a random move, it's a deliberate smart money play, a liquidity grab designed to trigger stop losses and shake out retail traders. Next comes the base. This is where accumulation happens. Smart money quietly builds their buy positions here, preparing for the next big move while everyone else is uncertain. During the base, there's often manipulation. They create false signals to trick retail traders into thinking the market might drop further. Finally, we get the rally, a strong upward move as smart money takes control, pushing the price higher. This drop-based rally pattern marks a key demand zone, a spot where smart money left their footprints. As a scalper, you know this zone is a reference point for institutions. When the market revisits this area, there's a strong chance it will explode higher again. Because when smart money bought here, they didn't do it all at once, they bought gradually to avoid spiking the market. When the price comes back to this zone, institutions have limit orders waiting, and retail traders who try to jump in too soon often place their stop losses nearby. The result? The market sweeps liquidity, triggering those stops and then surging upward, exactly the move we want as scalpers. But this is just 1% of the whole strategy. Keep watching because the next part will really show you how to leverage this pattern for consistent profits. Now let's switch to the rally-based drop, a classic bearish reversal pattern. The market rallies upward, hits a base where institutions start selling, and then drops sharply. This base forms the supply zone, where smart money leaves its footprints, creating a high probability area for future price action. When the price revisits this zone, institutions already have their limit orders waiting, and the market often sweeps liquidity from retail traders who have placed their stop losses just above the zone. This triggers a strong drop, exactly the move we want to catch as scalpers. Now, looking at this real chart, we see the rally-based drop pattern in action. First, there's a rally, a move driven by smart money as the price pushes higher. Then, the market hits a base. This is where institutional traders begin offloading their positions, creating a supply zone. What happens next? The price makes a sharp drop, but this is where we need to stay patient. As scalpers, we wait for the market to retest the supply zone. This is the moment smart money might come back in. When the market revisits this zone, it's our chance to enter quickly and catch the next downward move. The key here is the retest. That's where we can get in without needing to chase the move. Once we're in, we look to exit fast, locking in profits before the market fully reacts. Now, let me show you something truly powerful. In this same chart example, we can see the market creating both a drop-based rally and a rally-based drop, a perfect illustration of how smart money operates. First, the market forms a drop-based rally, creating a demand zone. As the market approaches this zone, it sweeps liquidity and then moves upwards. This is a classic smart money move, taking out retail traders before driving the price in their intended direction. Later in the same chart, we see the market form a rally-based drop, establishing a supply zone. Once again, as the market returns to this zone, it sweeps liquidity and moves downwards, trapping retail traders in the process. What's happening here is no accident. These are trading machines, algorithms programmed to trade this way. By mastering these patterns, you're essentially decoding how the machines and algorithms trade. The beauty of this strategy is that it's robotic. These moves repeat frequently in the market, offering endless opportunities. So by identifying where smart money enters and exits, you can start taking the same trades and trade like a pro. Now, don't take any action just yet. This is just the basics. I'm laying the foundation, but we're going to go much deeper into this strategy. So keep watching, because by the end, you'll know exactly how to use this setup to its full potential and make the most out of these market moves. Next, let's look at the rally-based rally pattern. This one's all about bullish continuation. Here's what we're looking for. The price makes a strong rally, and instead of reversing, it forms a base. But this time, the base isn't signaling a drop, it's just a pause before the price continues its upward move. This base shows us where institutions are building up more buying power, and when the price pushes up again, it confirms that buyers are still in control. Looking at this real chart, we can see the rally-based rally pattern play out perfectly. First, there's a strong rally. Smart money and institutions are driving the price upward. This is a clear sign that they're stepping in and taking control of the market. But here's where psychology gets interesting. The market pauses, forming a base. For retail traders, this might look like indecision or a sign that momentum is fading. But for those in the know, it's a completely different story. This base is where institutions are quietly adding to their positions, preparing for the next leg up. They're accumulating more buying power while keeping the market calm. What we're looking for here is the next move, the second rally. When the price breaks out of the base, that's our confirmation that buyers, led by smart money, are still in control. As scalpers, our focus is to catch the move when the price returns to retest the base. That's where we can enter quickly, ride the continuation, and exit just as fast with profits in hand.